Good afternoon, everybody. Thank you for joining us today. We're excited to have you here with us, talking a little bit about, as you can see, our topic today is financing a employee. And so we, due to the weather, we've had a little bit of adjustment to our how our speakers are going to work. Not to worry, you're going to hear from them, not from me. But Kirk Young is with Great Western Bank out of Fort Dodge. And he has decided, or he will be joining us remotely a little bit today. So that's why we won't see his pretty face up there. But rest assured, we'll be hearing his good advice. And feel free to ask questions. He'll be able to answer those in regards to ideas for financing a key employee. We also have Gary Lorenz with us, who is with Great Western Bank here in our local area as a market president. Both Gary and Kirk have, 25, 30 years worth of banking experience apiece, doing a lot of commercial lending across the state. And so we're excited to have them here with us to kind of talk through ways to finance the unfinanceable is kind of what I would call it. We got a little bit of a feedback issue, so I don't know if you're hearing that or not, but we're trying to get that resolved. So anyway, we appreciate you joining us today. I will let Gary and Kirk get started here and maybe talk a little bit about what we're going to try to cover in the next hour. But essentially, we're going to talk about, those key employees who we've got within our company that have helped us get to where we are with our firm. And now we're looking at succession and exit planning. And, maybe we're looking at who is a possible buyer of our firm. And if sometimes it's our family members, the next generation of our family. Sometimes it's a third-party buyer, but oftentimes it can also be a key employee within the firm. So there's a lot of benefits, obviously, to that kind of a transition. Those are the folks that know the employee base. They've worked side by side with them. They may be responsible for a lot of the growth within the company. They're very familiar with the processes, procedures, the suppliers. And probably most importantly, they're very familiar with the customer base. They maybe have established relationships with those types of folks. And so a transition to a key employee becomes oftentimes a real great way to sell your company. The problem is oftentimes those people have, or at least on the appearance, have very little in terms of assets and what I would call scratch or coin to put together to buy out the company. And so Gary and Kirk are going to be talking a little bit about strategic ways and creative ways to get that done, because it does get done and it can be done. And so we don't want to overlook a key employee as an opportune buyer for our company. So with that, Kirk, Gary, you want to kind of get us started?
Sure. And Kirk, you can go ahead and kick this off. I was just going to mention that we do have a slideshow, but the way these things sometimes work best is if we just, start, this can be later referenced, but by asking questions, I think it'll all guide us in to get some answers for whatever your questions may be. So Kirk, why don't you kick us off?
Yeah. All right, thanks, Gary. Dan, if you want to go ahead and move to that first slide, and Gary's exactly right. We probably won't cover every one of these slides in detail, but they're certainly available for anybody that wants them. And just to kind of build on and maybe kick this off on Dan's opening comments, in terms of the selling a company, if you're a business owner, you have several options in terms of how or who you want to sell your company to. Oftentimes it can be, a lot of these are smaller family-owned businesses, and sometimes you're trying to pass that along maybe to the next generation. And if that's not the case, you'd like to sell it to people that have helped build the business with you and have kind of gotten you to where you are. And in those cases, sometimes there are some concessions that might be made. If you're looking to sell the company just to the highest bidder and looking for just to maximize your price, a lot of times you're opening it up to maybe either competitors or others outside of the company. But our focus today really is on how to help maybe sustain the business, to pass along that opportunity to those individuals that are key, to the success of the company. One of the things that this slide kind of points out is a lot of times when you're selling the company to an outsider, and I think we all see this, oftentimes it's a new set of rules, it's a new set of ideas, some of which can be good and some of which can be bad. But sometimes, if you've got an outside firm buying your business, there's certainly going to be change. And if you're looking to retain a certain culture or trying to help make sure that your employees are well taken care of and that they are rewarded and the business continues to, in its own name, a lot of times you're trying to sell that company then to the individual key executives. So that's really all that, I would say here is that, you have to set your priorities, and are your priorities to help others, live that dream that, and have that success, or are you looking just to really maximize the dollars? The other, the option that was mentioned in here are ESOPs. Those, we're not really going to cover those, but that's another way to sell the company to insiders, is through an ESOP. And oftentimes it involves a lot bigger pool of people. So a lot of that depends on the size of the company. But again, our focus today really is on the financing key executives. So that's where we'll direct kind of our conversation. Yep. So I think the first thing, is really kind of trying to figure out, and you can slide it forward a couple of slides there, Dan, is really what's the company worth? And there are a lot of different ways to establish that value. You can look at, multiples of book value of a firm. You can look at multiples of cash earnings. What kind of tangible assets are in the business will drive a lot of that valuation as well. So, Gary, anything else that you might want to add in terms of, business valuation, or maybe engaging professionals to help with that?
Yeah, I think that sometimes the pre-work isn't done on that, and you have to start thinking about this before you're actually ready to sell, because there's ways that you can have people earn out ownership in that, and it makes it an easier transition. The other thing is that for those business owners that are used to taking a sizable amounts of money out to support their lifestyle or do all those other things, it makes from a banker's eyes, it makes the business not look as attractive as it may be. And so that kind of contemplates it when it comes time to sell. Now, that's up to individuals' appetite, but it's just something to understand.
You want to touch on that a little more?
Yeah, I was just going to say, I mean, if you get into a situation where there's a little bit of a disconnect between what the owner might think the company is worth and what the employees may think it's worth, or what they can afford. I mean, there are firms that are out there that do business valuations, and sometimes you may need that anyway for the financing, depending on the assets that are there to support it. But I think Gary hit on it earlier. The best advice there is to start early in terms of trying to establish what that valuation is, so you're not springing that on whoever it is that you're trying to sell it to internally late in the game. There's a lot of preparation, and it may even take years for them to be in a position to be able to buy the company. And the sooner everybody is in agreement in terms of what that price is going to be, the better off you'll be from a planning standpoint.
Okay. Kirk, not to belabor this, and I know we're focused on financing that employee, but in terms of the business owner, the business owner is spending their time minimizing taxes as best they can. On an annual basis, they're pulling out as much out of the company, sheltering as much, trying to show as little profit as possible a lot of times. And I know that we've talked earlier about how that can kind of come back to bite you. Can you kind of elaborate on that? Kind of what you would advise a business owner?
Right. And so, Yeah, I mean, you're exactly right. There's a lot of year-end, sometimes income, management, if you will,
Yep.
in terms of trying to avoid taxes and the tax man. And there are some, I think bankers will take a look at what's being pulled out of the company and make sure that I mean, there are some add backs that can be given or provided. But we want to make sure that the individual is not pulling money out of the company at the detriment of its future viability. So in other words, that they're not just draining cash out of the business and foregoing reinvestment in machinery and equipment and keeping it modern and up to date and competitive and all of those things that that you need to make sure that when the new owner comes in, that the assets are fully depreciated and they're left kind of holding a kind of a shell of a company what its former self was, because the owner was using most of that to sustain their lifestyle. So there's a balance there. Bankers will oftentimes coach owners of businesses, and a lot of times they've got financial covenants in place when they've got financing in terms of showing debt service coverage ratios that have to meet certain requirements.
Yep.
And there's a reason for that. And so it's important that the business, if you're setting yourself up to sell, profitability is a good thing. Banks need to see profitable businesses because that's what we're going to use as the basis of our source of repayment. So you have to balance the two, most definitely. So.
Okay. I know we'll talk about that more, that there's I've always, or used to think always about collateral as king, but really it's cash flow more so. And so I know we'll talk on that a little bit farther, but I'll let you get into this slide now, maybe.
Yeah. And Gary, you've got the slide in front of you, I think, don't you?
Yes.
Yeah. I'll let you kind of maybe hit on a couple of the highlights out of there, and I'll jump in maybe after.
Yeah, I believe that what we were talking about before, I think that start now on this slide is a key. It's you need to weigh out the options and if anything, start early, as we said before. Just to hit on that again, maintaining a profitable business. When a lender's looking at this and looking at financing the transition to maybe a key employee, and we've come across numerous instances, at least in my banking life, where that they want that to happen because it's the right thing to do because of the loyalty of that employee and all those other things. But there's always some coaching that can go along. Even if you have to go the route of an SBA guarantee, for example, it's very good to have some cash in, because they're going to require 5% cash from that key employee to make this thing all work. And that was changed a little bit, but it started out in January of this year where they have to have 5% of the transaction in cash, and it can't come, the repayment, if you were to borrow that 5%, can't come from the business itself, the proceeds or the profits. So it's very important to start early. If you have a key employee and you're paying them pretty well, they need to be thinking about this in the future, that maybe they have an opportunity to buy into the business and they should be saving some money, or maybe they have an opportunity to contribute in exchange for some stock in the company, those type of things.
Okay.
So just, really develop a roadmap and a plan that's a little bit more than, okay, I got about a year from now, I want to be retired, I want to sell this business. It makes it more difficult.
Yeah, I think the only thing I'd add maybe to that is that just in terms of identifying, you've got to make sure that you start talking to some of these key executives, and so they know that they have to do some things to try to help buy the business. I don't think a lot of these potential buyers typically would have the financial means to do it on their own. And so they have to really plan for it I think we see this, I think Gary and I see this probably more often than not. And that's people that want to buy a business, but they really don't have any money saved. And they may be making really, good income, but they really have to be disciplined to be able to contribute their own funds. Every dollar counts in terms of equity down payment, and the more the better. If you come to the bank, or even through an SBA loan, you have to have some skin in the game, and very seldom, it seems more often than not, you'll see these people are really scrambling. I mean, they're tapping every potential source of equity that they might have, especially if they haven't spent some time saving and planning for it. So,
okay.
And then to add on to that, even when we can piece some of those things together, then the first question is, or maybe just a few months into it, it's like, hey, I need another $400,000 or $500,000 for cash flow in this business. And so those things aren't thought of in the beginning, and then they're so leveraged that it makes it very difficult to expand and move the business forward. And in some of those cases, who's ever selling the business still has some skin in the game, and probably not any of the collateral. So then that sets it up so that the repayment of that's going to be difficult down the road.
They're sitting there naked, type of thing.
Yep.
Okay. All right. So how to finance here? Your own funds. We all wish that were the case, type of a thing. But you want to walk through this a little bit, Kirk?
Yeah, absolutely. And again, this is a rarity. This is probably in terms of somebody that really can utilize their own funds to buy the business. It generally is one of those, and you'll see as we kind of go through these slides. Typically, you're having to go to a handful of different sources to make the acquisition. This being one of them, but generally speaking, as I think Gary mentioned, a minimum, even if you go through the SBA, a minimum down payment is going to probably be 5%. And that just is the down payment. That doesn't cover, additional closing costs that you have to think about. Some of those can be financed, but some of them probably would not be. So, you're looking for sources of equity that could be, equity that you might have in a home, might be equity that you have in a 401k or some type of profit sharing. Any of those items that you can actually turn to cash to use as your down payment. So I think generally speaking, I don't know, Gary, what you would say here, but we probably see most people coming in way less than 20% of their own funds, probably more like 5 to 10.
Yeah, absolutely. I see the same thing. I do have a example of this just real quickly in that it would be, I have a business that does very well. It's plus 12 million in sales. They have a couple of key employees that run they each run their own side of the business. And the one is compensated very well to the tune of about $120 a year in salary, and his bonuses have been in the $400,000 to $500,000 range for the last 3 years. Maybe not quite that as an average, but the last year certainly was in that range. And when I sitting down with them, the owner's looking to sell, and of course he'd like these key employees. They've been loyal, they've been there 20 years, blah blah blah.
Yeah.
And
they should be well financed.
Yeah. He has no savings whatsoever. He says, maybe I can scrape together $100,000. And it's just, and the owner's jaw just dropped. He was like, wow, this doesn't make any sense. But that's where that pre-planning comes along. His words to me were, I'd like to be done with this and be moving on and retired in Florida in a year. Well, that's going to be very difficult. It's probably going to work out in some way. It didn't need to be that difficult if you would have planned ahead of time.
We got a question or maybe a point here. I'm not exactly sure from Steve out there. The comment about profitability within the business to make the business more attractive for buyers and buyer financing. Business owners should consider the income tax paid as an investment, the ROI coming in the form of a higher sale price or easier sale process. So I think what this Steve's point is you're paying the piper on the front end maybe, but that can be looked at as as kind of an investment for future payoff down the road when the banker can see that, yes, this business has been profitable and paying taxes, and therefore is, we're going to give it a little bit of a premium from a valuation standpoint, or it's a more financeable transaction. Kirk, does that kind of flow with what you were thinking when you were talking about that?
Well, I think kind of what we're going to look at is in terms of overall profitability, we'll look at what the executive compensation has been in the past, and we can try to transition like a pro forma going forward without that that current owner's salary, and what the change might look like. A lot of times we'll see distributions that the owner is taking, and we'll try to work through how much of that we can add back for repayment.
Okay.
Yeah. I mean, I think the profit. I don't really know that I think of income tax as necessarily an investment. I mean, it's just a cost of doing business.
Sure.
So our key is that we're gonna look at the EBITDA. So we're gonna look at what kind of EBITDA is there over the last 3 to 5 years from the business, and kind of use that as our historical number to establish kind of what kind of debt is the business can service. So
Okay. All right. So maybe with that, we'll get into the seller financing piece of things now, and that's where we're talking about what I think is otherwise called maybe carryback. Is that correct?
Mm-hmm. Or carryback, hold back, seller hold back.
Yep.
So maybe walk us through that. And so for the owners that we have on the call, talk a little bit about what am I going to be expected to hold on to, and how am I protected to get what, that last piece of the, as Gary was talking about earlier, the last 20 or 30% or whatever I've got to hold on to as the owner. Can we talk through maybe an example of how that might look?
Yeah. Gary, do you want to talk about that SBA but item as far as the carryback and how that works?
Yeah, there was a business that we're working with, which is, I think, a good example because it's $1.5 million price tag on that, and that valuation was done buying the assets of the business. And this happens to be a business that is asset heavy, but not real estate involved. But it requires a lot of equipment to do what they do. There's 2 employees that have been with the company for 7 years. They're not real highly paid, but they're paid well, I would say. And it makes the most sense for them to move on to the business. And it's actually their father that owns the business, and it's a son and then a nephew that want to buy in. So there's a family attachment there, and it makes a lot of sense in this. And so we're looking at that as probably an SBA because there isn't a lot of cash available, so they can get in with 5% cash. The way that worked was we in SBA the 7A requires that you have 10% cash into the deal. 5% of that has to be cash. 5% could be the holdback from the seller, or you could hold back more to make the deal work. In some cases, the seller may want to hold back more just to avoid some of the tax consequences of getting. In this case, it was $1.5 million business, so 10% is $150,000. They have to come up with $75,000 between the 2 of them. They do have some personal assets, although a lot. The one young man was single, so he didn't have a secondary source of repayment for the 75 if he was to borrow it, and didn't have it in cash. Had equity in his home and that, but that wouldn't work for him because he would have to use the proceeds from the new business to make those payments. In the other case, the wife was a RN and made about $90,000 a year. And so she could service that debt. So that's the way they structured it. So we were able to put together, they were able to obtain a home equity loan for 75 with the idea that she's going to use her income to service that debt.
On the home.
On the home. And then the other 75, and in this case, we actually, the seller went up to, he's going to hold back 300,000 because that way, with the understanding that he would receive no payments on that whatsoever until the SBA guarantee and the bank debt have been paid and satisfied.
And so the owner is last in line, correct?
The last in line, so he has to agree to that. But for him, when he went to his tax accountant and he looked at the depreciation he's taken on all this equipment and everything, he was able to figure it out that would lessen his tax liability, and it worked for him with dollars and cents.
Because he could spread the income over a longer period of time, essentially.
Exactly.
Okay.
And then the expectation, in this case, it's his son, and most likely he doesn't. Once he makes the deal, the bank has all the collateral.
Yep.
And so he's hanging out there for 300,000 with essentially
right?
Unsecured loan, but it's to his son. So it works. It works in that case. You know, he probably wouldn't have done that with Kirk or I.
In that situation, another question, Gary, would be, so that there were two of them involved as buyers. One had a spouse with an income that could support the borrowing of some equity out of the home to use as down payment money. If it had just been the other individual who was single at the time, how and not to put you on the spot, but would there be a way to creatively figure out how that person could have figured out how to put together a 75 grand? You know what I mean?
There was also another source there, and it was an uncle of his that evidently has liquid cash.
Yep.
And he was contemplating doing that with the idea that he wouldn't be able to make any payments on that, and he would be secondary to all this, and he would have to agree to that and sign off on something. So it was almost like a gift, but then paid back later after the other debts are paid in full.
And if we continue on with these, I have a few more questions because now we're talking kind of about structuring a deal, right? And so if I, as the new business owner, I'm running this enterprise and I start to get into some trouble, or things go south on me, I'm assuming that rich uncle or whoever a third party investor might have been to come in with a little cash infusion to help me get my down payment money, I'm assuming they're not co-signers in any way, shape, or form on any of the notes, and so what they're in for is all that they're in for. You know what I mean?
Exactly.
Okay.
And there could be some strings there, on the side because you're family and all that good stuff.
Sure.
But no, you're just secondary to everything. That's why, this is another deal where, I'd like to sell this business and be out of here in 90 days in this situation. And so he's just, he's tired of it. He wants to pass it on. He believes that this is the right thing to do because they put a lot of, hard work and sweat into it, even though they didn't have ownership. And so it makes sense for him. He's trying to do the right thing by them.
Yep. But
it makes it more difficult. However, himself, asset-wise, he can do without the 300,000 that he's in seller holdback, so that makes sense. And plus, he won't get hit with a lot of income tax or capital gains tax right away. And it was a little bit complicated because some of it, the blue sky that they were paying for the business over and above what the assets were, is definitely taxed as a capital gain.
Sure.
But some of the other assets that had been depreciated down were taxed as ordinary income, and that's very costly.
Yeah, absolutely.
Yeah.
Especially depending on the bracket you're in, but okay. Kirk, anything from you as far as, I noticed it said on there 30 to 60% in seller financing, and is that kind of what you see? And then also, how long does it take? I often refer to a business owner as founder Frank, the person who's selling the business to the next generation or the new buyer. How long does Frank have to wait typically to, I know it depends on the strength of the cash flow and everything, but are we talking, 20 years and Frank's now a 90-year-old guy and almost dead type of thing? Or, how long?
Well, yeah, it kind of depends a little bit on the structure. In the case, with those SBA financing, a lot of times they're smaller. They're typically not large percentages of the overall transaction. And like Gary said, you have to kind of leave it in there for the duration. You can't even take an interest payment. But if I'm a seller and I'm going to carry 30 to 60% of it, the reason I'm probably doing that is to assist or help the buyer get more conventional financing. And by that, when I say conventional, I mean
okay.
do it without an SBA guarantee.
Okay.
So a lot of times, what ends up happening, a lot of times the banks will bring in the SBA to, as an additional credit enhancement. And many times that credit enhancement is because there's just not enough collateral.
Okay.
So the more that the seller's willing to carry back, then, the better the chance of the new buyer being able to get a more traditional bank loan. Because, you're basically, that seller as a subordinate debt holder is really unsecured. I mean, in most cases, they're willing to defer because they have a high degree of confidence in the new owner or the buyer. They might be a family member, or there may be some tax reasons that they're doing. But the other thing I mentioned, we have a client here in Fort Dodge, and what they've done is they've identified a couple of key individuals, and they've allowed them to buy, rather than selling the company all at once, they've allowed them to buy 5% of the company, each of those individuals, so a total of 10%.
Yeah.
So, you can kind of chip away at it too. You can, you don't have to do it all at once. And if you're planning far enough ahead, you can kind of maybe do a little bit better job in terms of tax planning and making sure that from a financing standpoint, they already have some ownership, and sometimes that may help a little bit because they're getting to see kind of what it takes, so to speak, to run the business as an owner as opposed to just being an employee.
Okay. Does that have any implications when you're doing the transaction of asset sale versus stock sale? I feel like on the SBA side, it has to be an asset sale. Is that, selling them a few percentage points, 5% of the firm up front, a few years up front? Does that complicate anything? Or?
I don't know if it complicates anything. A lot of times with the asset sale versus a stock sale just probably has more to do with just not having any trailing liabilities or any potential liability for the new owners.
Okay.
And I think that generally, Gary, that's kind of what I see as far as an asset sale versus a stock sale, that the new owners typically are getting advice from attorneys that's probably a better way to go.
Yeah, probably 90% of the time.
Okay.
Yeah.
Okay.
Yeah.
All right. Maybe we can move on into this bank financing then. Does that sound okay?
Yeah.
And please, if anybody has questions, please type those in as we go here. If you've got a specific situation and you can create a little bit of anonymity about it, please ask your questions. We'd appreciate those too. Go ahead.
Yeah, and I'll jump on. I'll start on this one, Deanna. In terms of a bank financing, typically, and I think most of the business owners, they've obviously been to the banks already. They know what it takes in terms of the financial information that you have to provide. One thing that we do see from time to time that can kind of torpedo a deal is credit history for some of these potential owners, and just making sure, if you go to the SBA route, they typically have some kind of minimum standards, as do the banks. So that's one thing that you have to kind of keep in mind. You might have some owners or potential owners that might have some nicks here or there, and that's another reason to kind of get started early, because if they do, you want to get those worked through before it's time for them to go to a bank to borrow, in some cases hundreds of thousands of dollars, or maybe even $1 million or $2 million. But generally speaking, just on the bank side, I think you'll find that most banks would try to finance an acquisition conventionally if they can, but the big hurdle ends up being how much blue sky is there in terms of the sale. And if there's a lot of blue sky or goodwill involved, and you just can't have or don't have the right amount of collateral, oftentimes you end up defaulting toward an SBA loan. But I would say that in most cases, banks would prefer not to go the SBA route if they can piece together enough collateral to do it, and they're comfortable and it's within their policy guidelines. Generally speaking, that's what they try to do. Gary, anything else you add to that?
No, I think that banks on the conventional side, on the conventional loan, they're looking for, the primary source of repayment is the cash flow of the business. And in the businesses that I see, that's usually fairly strong if they're looking to do something like this to a key employee. Then secondarily to that, if you're going to qualify, the secondary source of repayment is usually the strength of the guarantor, which would be the new buyer.
Yeah.
And so the stronger that is, again, if you kind of go back to working on this earlier, and if you can strengthen that somehow, then that makes the deal a lot stronger. Wouldn't you agree, Kirk?
Yeah, absolutely. Absolutely. And we'll see in some cases, we'll see outside guarantors, and that oftentimes could be a family member, or, maybe it's somebody else that they know, but generally speaking, it's a family member and I would say that those tend to be maybe kind of on the smaller transaction side. That could be another credit enhancement that we might look at. But at the end of the day, even with really good collateral or really good guarantor support, you have to be able to look at that primary source of repayment, and that's how much money does the business make, or how much does it generate to service debt. If you don't have that, that's going to be, then the bank is going to look for maybe another way to structure the financing. So
Okay.
And as Kirk mentioned before, I believe that there are some add backs to this. I mean, because owners take bigger salaries and they won't be there anymore. So some of those things can be added back, and it enhances the transaction. So we don't want to be, make it sound like this is a hurdle you can't jump over, but because those things will happen. But again, I hate to do this, but keep going back. The planning of this is very important.
Yeah. Okay. Okay, so now, as we're going down the list here, now we're looking at SBA, and I think this is correct, but I want to verify. So for those out there that are maybe less familiar, when you're going to the bank to talk about the financing package, it's really kind of more at their discretion and their advice on if you go with conventional versus SBA, and it's not like you're going to a different provider to get the SBA service type of a loan. You get what I'm talking about, Kirk? I mean, that isn't something the borrower has to worry about as much, as long as they're working with a competent banker, correct?
Yeah. I mean, it's not very often that somebody comes in and says, I want an SBA loan.
Yeah.
Usually they're coming in, they just want a loan, and then it's really between the banker and the prospective borrower or buyer. You kind of we'll work through the questions that in terms of collateral and financial information that we need, And that will really dictate or kind of drive, the direction of the application, and whether or not we need to get SBA involved. So, again, if there's a way to do it without the SBA, we're okay with that, by and large, because it's a little less expensive. There are some fees involved with SBA. There is more paperwork, and I know that if there are any SBA lender or SBA folks that are out there, I mean, they've done a nice job of making the process simpler and easier, but it is still more paperwork than a conventional bank loan. There's just no disputing that, really.
And at the end of the day, both the bank and the borrower are saving money if they can avoid the SBA portion of things, right?
Absolutely.
It's not just the bank grabbing all the money, you savages, right?
And it's not any harder, but it is in a way, in a sense. I mean, bankers would tell you that they would rather do conventional loans all day long rather than do an SBA. But it does serve a purpose, and it does allow for things that are exceptions to bank policy or their lending policy.
Oh, yeah.
It allows them to get over the hump because they have that guarantee from the SBA.
Okay. I don't know, Gary, did you see this question here from Michelle? Do you want to address that right now?
Yeah. So here's the question from Michelle. How much personal collateral would a bank like to see? And maybe I'll let you answer that, Kirk.
And she's framing it as personal collateral versus business collateral.
Or would you only show business collateral to the bank? That's her second part of her question.
Yeah.
I believe, if you're buying a business, the business collateral is going to come into play. When we were talking about the primary source of repayment, we talked about the cash flow of the business. What's securing the loan is the primary collateral is the business collateral. Now, whatever banks will, lend more money or do things much differently if we know that who's ever the personal collateral of the guarantee of the loan looks really, good and robust.
But if you don't have to throw that out there, don't probably, right, from the borrower standpoint?
Yeah, I would say, but we normally, who's ever buying, we require a personal financial statement from whoever those borrowers are going to be. And then there's another question here. I've been told when getting a business loan to never allow a personal guarantee. That from a buyer standpoint, that might, or from a customer borrower standpoint, that might be something that they think about. You don't see many of those deals that are done that way, however. Banks almost always require that. I think that when they don't, it's when an entity is real mature and it's the business just stands on its own, so
those are rare cases, obviously.
Right. Just it is more rare than not. But Kirk, you want to try to handle that one too?
Yeah, no, I would agree. I would say that it's certainly the exception if we don't have any personal guarantee. I mean, there are ways that you can, depending on the strength of the business, and you can negotiate, either maybe some limited guarantees or where you can have over a period of time those guarantees can be reduced or lowered. But usually, I would say generally speaking, 99% of the time, if you're buying a new business and you're pledging the assets of that business, you will have to provide a personal guarantee. Now, where we see sometimes banks will, and as a borrower you have to be a little careful, is let's say you're buying that business, you're one of 4 or 5 different people. You've got 25% of the ownership, and the bank is asking you to guarantee 100% of the loan. Well, that probably feels lopsided to a lot of business owners. But in most cases, banks are going to say, look, I just need to be able to go to one person to be able to get our loan paid back. So a lot of times you'll have to guarantee, 100% of it, but you may be able to negotiate, depending on the financial strength of the business, what we would call a pro rata guarantee, which is based on your ownership percentage.
Sure.
But by and large, unless you own, if you own more than 20% of a business, you're probably on the hook for something. I would say, especially at the beginning. As Gary said, we do have some, we do make loans without personal guarantees, but those are generally to very mature, profitable businesses that we've done business with for years.
Okay.
And so if you're looking at just at the very beginning and you're trying to buy a business, I don't know how you get around not having a personal guarantee, to be honest with you.
Sure.
Right. And then Michelle has a third question here that I'm a service-based company, so a lot of blue sky. And I think probably what you're getting, that in some cases that can be a good thing. From a bank standpoint, it limits the amount of collateral, but if you have really a strong pattern of earnings performance and your financials look good, really at a service company, your accounts receivable is part of your collateral.
Yeah.
So that can, in some of those cases, can be very strong, and we would look at it that way. So I wouldn't let that deter you from, trying to get top dollar. And the blue sky is very important for you. You got your sweat equity over time into that business. You build it up, and that should fit. I don't know if you have any other thoughts on that.
Yeah, I just in terms of the blue sky, it can be in the form of, it can be, with a service business, but we also had a situation here where we're financing. It's a pretty sizable acquisition. It's a $3.5 million roughly sales price, and a really mature business, and not much in the way of, in terms of book value of fixed assets. Okay. So a real strong earning company, and that's what the valuation was really based on. It was based on a multiple of EBITDA as opposed to true value. And so to give you an idea, they had the intangible assets were greater than $500,000, and in this case they were quite a bit more. And we ended up doing an SBA loan because of that, and they required a business valuation. So we had to hire a third party to come in and support that that the new buyers were, the sales price was fair. That the owner wasn't, kind of, pardon the language, sticking it to the new guys, sticking it to the new owner. So a lot of times you can go through that business valuation to establish the your ultimate sales price and what we're basing our financing on.
And sometimes the business valuations can be a multiple of earnings, or those type of things that come into play. It sort of depends on what type of business it is.
We do a lot of that kind of help with firms on what I would call rule of thumb valuation type of work, where we help them get a range based on a multiple of EBITDA or SD&E or cash flow or whatever it might be. Should we maybe?
We got one more.
Okay, I'm sorry. Yep, one more.
One more question up here. It says, this is from Kevin Flagg. I have found that most banks won't finance a sale unless the owner stays for 1 to 3 years during the transition to the new owners and managers. Your thoughts? I think that could be true in some cases. I suppose if the manager is the business and they're the face of the business, and that the business could potentially fail, and they're bringing in somebody that really isn't the face to that business. But I think for what we're talking about here, and numerous examples that Kirk and I have talked about leading up to this, it's usually to a key employee. And so probably wouldn't need to happen that way, because in a couple of the ones I can think about that I'm working on right now, the key employees that are trying to buy the business are the business at this point.
That's a good sign, obviously. Right?
Yeah, and it's a good sign. So kind of depends on, what you're dealing with.
Okay.
Yeah, and I think you kind of look at a couple that we've looked at. In this one, the one I was just talking about, the owner had really kind of been an absentee owner for probably the last 5 to 10 years. He really had been leaving the day-to-day management of the company to these 4 key employees. And so you have to make sure that the new buyer, if they have years of experience in the industry, that's critical. But also if they have, a lot of experience with the company, or have been a long-term employee, that will mitigate some of that concern about having the prior owner in the business. And so if you think that there's a lot of times that you'll see somebody that's selling the business, they're kind of capitalizing on maybe an opportune time. The market's good, and they're younger, they're not probably near retirement age. You're going to make sure that they're signing some type of a non-compete typically.
Sure.
So they don't jump right back in 3, 4, 5 years later, and all of a sudden they're a competitor and not a, and then that can happen, right, Gary? I mean, you can see that where guys will jump right back in 5 years later. So
yeah, so that's a big one, because you just don't know intentions of people.
And how long can you really, I've heard of non-competes. Typically, it's hard to get those to stay enforceable after maybe 3 or 4 years. So, you know what I'm saying, Kirk? I mean, you want to protect yourself. I mean,
a couple years, and a lot of times the party's over. But it kind of depends on the business, I would say, in my opinion, because there's some businesses that are they operate in a niche that you can't replicate, and after a couple of years you're going to kind of tie up the customers. As long as you're doing a good job in servicing them, then it probably is going to stick. If it's something that it's wide open out there, then I would watch out for that.
Okay. And some of
yeah,
that.
and you typically probably, I would say most of the time you're going to see those non-competes if you're selling to an outside firm. I mean, they'll require that.
Yeah.
If you're selling to an inside employee, you may still need it and still want it, but if they've got some seller carryback, or if they're carrying it and they're still in it, they're more than likely not going to.
Sure. They're not going to want to.
They're going to torpedo, the business. But it's a key factor, and it's definitely one you can't forget to include.
Okay.
Yeah.
And another thing along those lines, I mean, try to deal with a banker that has done this before, has experienced some of this, because there's a lot of bankers out there that haven't experienced this.
Sure.
And they're just doing the cookie cutter deals that come in, and they want a line of credit to operate their business, or maybe a real estate loan or something like that. This gets into a little bit different thing, and you're giving advice to people that is going to value their business and the livelihood of them moving forward. And so you want to deal with somebody that's experienced. This is my thought.
Okay.
Yeah, and I would say that in addition to an experienced banker, you really want to make sure you have a good tax professional or an accountant or CPA that's kind of helping you throughout, through the valuation process, and an attorney that's looking out for your best interest. I know when you're selling to you're buying it from current ownership, there's probably a lot more trust maybe than there otherwise might be.
Yeah.
But it's still important. And we as banks like to see if those other professionals kind of with another set of eyes on it, to make sure that the purchase agreements are fair and not one-sided, and the new buyers are protected.
Okay. All right, maybe we'll quickly touch on LBOs. We're running out of time, I know, on our 1 o'clock. We want to.
Yeah, and I don't know if I would spend a whole lot of time on this one or the additional one. I mean, leveraged buyouts typically, it's where you're just leveraging up specific assets in the business, but typically the bank is going to they're going to get all that collateral anyway, frankly. So I think that in the last couple of slides, the two things that I would probably hit on most, Dan, would be, just in terms of be ready for the closing costs and factor that into your equation. And because I don't think a lot of people might be surprised. If you're doing an SBA loan, a lot of times, those fees can run 3.5% of the transaction. You can finance it over a period of time, but there might be a little sticker shock for some folks. So you need to kind of make sure of that. And then something that Gary talked about earlier is making sure that you have thought about financing the business after you own it. So don't. Everybody gets pretty fixated on just getting the business purchased, but if you come knocking on the banker's door 60 days later and say, "Oh, hey, I need to buy this new piece of equipment for $250,000," or by the way, I forgot to include a line of credit. My cash flow is running a little bit tight right now. Those are going to be harder conversations. You need to address those right from the get-go, and make sure that you understand what the cash flow needs of the business are after you own it. So,
do you, as the banker in that situation, wear a bit of an advisor hat where you're working with that new buyer and talking through what exactly it is that they're buying and help kind of guide them with, how much do I have to have in a kitty for payroll and operating expenses for 3 months before my accounts receivable start to flow again? And how much can a borrower rely on you as the banker, especially in some of these key employee types of conversations where maybe they've never been exposed to those kinds of cash flow types of issues? Kirk, Gary, you want to kind of walk through that?
Yeah, I believe what you're getting at is when you're going into this type of thing, you want to have a really good pro forma.
Yep.
Because that'll give you the experience. So, and you test it out and say, if I can increase sales, let's say sales go up by 20-30%, and you got to understand your sales cycle. So when's the cash going to flow back in?
Right.
And if it's a longer period of time, then I experienced that when I came in. They made a few loans here before our bank opened up in the Cedar Valley here, and I kind of came in between. So there were some loans on the books, and I had a customer that was struggling along. And as we went back through and met with them, and we understood and that was a business they bought, and they just didn't understand how much cash, and their sales were on fire, but their sales cycle didn't allow, and they were constantly having a cash crunch, and we were able to, refocus on that and put it out there again. And then we were able to establish a line of credit, and now they're fine. But if they would have done that in the beginning, they probably wouldn't have, been scared to death going through this, because it was to the point where, they were consistently overdrawn, and this kind of thing. And it just really, the bank sort of did them a disservice in not understanding that. But if it was a key employee buying a business, it's always good to do that pro forma. So Kirk, you might have something to add.
Yeah. Well, yeah, and really, just as you're going through that, Gary, kind of one thing kind of really popped up. One thing we didn't include here, and it's kind of a glaring omission now that I think about it, is a business plan. When you go to the bank, you really have to have a business plan, and it has to be more than just a few paragraphs that, these are our key customers, or these are our key employees. You really want to, and you can seek. There are different outlets that you can go to help you develop a business plan. And the banker is going to want to see that. He's not going to write it for you. He wants to see what you know, and how much thought you've given into, really thinking about financing the operation going forward, how you're going to make it successful. So that is key. And you need to really take time to work through this. You can't just slam it together and say, "Oh, here's a business plan." You really want to really use that as kind of your guide to kind of explain how you're going to pay that loan back and how you're going to be successful. So,
okay,
yeah, absolutely. And
Yeah,
we,
go
and we
ahead.
do have one more question that popped up. So is there any loan out there available to purchase stock instead of assets to purchase a percentage of an existing S Corp as a current key employee? I can take a little bit of a crack at that, but I think, yeah, there certainly is. I think this takes careful planning, and it alludes to just what Kirk just said was you got to have a good tax man and a good attorney on this type of a thing. And your due diligence has got to be firm, because when you're doing this, you're not only purchasing the assets, but the liabilities.
Yep.
And there could be liabilities out there that are legal and all those kind of things. You need to understand all that to a T, make sure there's no, judgments or anything outstanding, or any lawsuits. And then, yeah, it certainly can happen that way.
Yeah, we financed a couple. We have mentioned this earlier. 2 key employees of a company we do business with, and they sold them 5% of the stock. And it was a fair chunk of change. It was a couple $100,000. But we had to look at more kind of personal assets in terms of sources of collateral, because most banks can't take stock of a privately held company as collateral. I mean, legally maybe they can, but they're not going to really be able to use that. There's no market for it per se. But there might be also, and in our particular case, we were able to get a repurchase basically agreement that if they defaulted, that the company said they'd buy whatever was left, back owing on the stock. So that was helpful. And you want to structure it, I would say over a 5 to 10 year period maximum. You can't, you're not going to take 15 or 20 years to pay that back. And oftentimes you're doing it out of personal, really resources. So, but you can do it. You definitely can do it.
Okay. If we could just kind of well, first of all, if anyone has any more questions, please send those in. I know we're just a few minutes after 1 o'clock, so I want to thank everybody for being here today. I also want to give a plug that our next webinar will be next month on May 23rd at noon, same place, your favorite chair and your laptop, and we'll be talking with the ownership of Agroplastics, a large plastics company out of Fairfield, Iowa, and they will be talking through their generational succession. So today we've kind of covered how to, how we might be able to finance a key employee, and next month we'll be talking about how we make that transition from generation 1 to generation 2, or whatever generation you might be on with your firm. So just so you know that May 23rd we'll be doing that. But back to our current topic, I was wondering if we could, from my standpoint, just as an understanding as a borrower, then if I want to buy a $2 million business, my minimum amount of cash coming into that operation is 5% of that. I'm not doing the math real quick, but I think that's about $100,000. That's what I would have to have in liquid capital to bring in just to buy the business out, and then I should plan for another 10% of the purchase price for closing costs. Kirk, I think you've got written here. And
yeah, and that might be a little bit, it could be a little bit high, but depending whether or not it's SBA. I mean, that typically would be if SBA was involved, but generally speaking, it depends if there's appraisal costs, and I'd say by and large, most of the time, most closing costs are going to run you anywhere from, at the low end, probably $4,000 to $5,000. At the high end, maybe 20, 25. If you're not, and that doesn't include like SBA fees. But it kind of depends on how big the purchase transaction is and how many people get involved. So,
and if it's real estate involved, it can get a little more complex.
Okay. It's pretty common, I assume, for the bank to want to see the real estate involved in the purchase price if you're buying it from Founder Frank, or, because sometimes maybe Founder Frank wants to hold on to that property and get a nice, sum of money on a monthly basis type of thing. What are your thoughts on that in terms of when you go to buy a company?
Yeah, I mean, you end up taking the value of the real estate out of the transaction, but that can happen. The owner wants to retain the building, and he'll rent it to the new owners, but he's not going to get paid for it. He's not going to get his value, right? So
the bank would rather see that involved in the deal, maybe, or not necessarily.
It just depends on the deal.
Okay.
I would think that if it's a key employee and a lot of the dependencies within the business are around the real estate,
you
probably want to own it.
Yeah.
Just because you want to, I guess, distance
Minimize
yourself.
your risks.
If you're buying them out and they're going to be done and gone doing whatever they're doing, that's probably the best way. But it doesn't have to be that way.
Okay.
No.
Yeah, I agree.
Okay. And then when you're saying, Kirk, 3% roughly, fees on SBA. So if my $2 million deal, is that roughly another $60,000 in SBA fees that I'm assuming are financeable into the deal?
Yeah, they are financeable, but that's typically what their fees are. It depends on the amount that you borrow.
Sure.
So a little bit lighter or lower when it's a smaller loan amount. But yeah, they can get up to 3%.
Okay. So that's where we're, as a borrower, we want to make sure that we're thinking about all that nickel and diming that's going to happen. And okay. With that, maybe I'll let you guys have a couple of last parting comments, and we can talk with any other questions that we might get. Is that okay?
Yeah. I guess for my 2 cents, if I was to give somebody advice, it would be to plan early. If you're thinking about selling your company, then I would, and you really are serious about wanting to sell it to inside employees, you need to have those conversations. I would say at a minimum of 3 to 4 years, maybe even 5 years ahead of time, so that everybody can really understand how it's going to work and the exit strategy. Because, and not that it takes that long to do it, but it just puts everybody on notice. Some people may be a little bit reluctant to do that because they don't want anybody to know that they're going to exit the business. So you want to keep it in some cases, highly confidential, because a lot of times these are small businesses, and the owners are viewed as they're kind of one and the same.
Correct.
But if you're really serious about it, you owe it to yourself and the prospective buyer to lay out the roadmap of how you're going to get it done.
I think that can be a tricky conversation too, where you want to approach a key employee and do right by them by giving them maybe the first right of refusal on buying your firm. And maybe even you'll take a little bit of a discount because you want to continue the legacy of the company and ensure that all the other employees have a place and a job. But if there's a little bit of wishy-washiness in your own mind about what that key employee is going to say, yes or no, then you're kind of worried that, okay, am I going to alert this key employee now that I am looking for a buyer, and now they're going to be looking for a new job type of thing? Have you seen that when you talk to owners?
Well, and that's where I think it makes sense to and maybe you don't have to come right out and say, hey, I'm selling my business in 3 or 4 years, but offer them an opportunity to buy in to the business.
Okay.
Either incrementally or just a little bit at a time, and you'll find out quickly whether or not that employee is thinking along the same path as you.
Sure.
So might be one way of tackling it. So.
Okay.
Yeah, and along those lines, I'd say just be genuine about it if you're a seller. I mean, if you're going to have those conversations, then you got to deliver on it. I think it can be if you do it the right way, it can be a very positive thing for you and the employee, because they start to get, they call it, skin in the game or whatever you want to call it. It changes behavior, and it really, run it like you own it type attitude. So I think it can be a real positive thing. But again, you don't have to say that you're wanting to sell, but you want to make sure that you might be wanting to sell, but you don't have to convey that. You just say,
Right.
hey, here, I want to start to involve you in this thing more. And,
Sure.
And we want to give you some ownership.
Okay. Do you want to cover this last slide that we're looking at, Kirk? This is kind of I think, an example, fictitious example.
Yeah, and I think the point of this whole slide really is that, you know, there's not a one-size-fits-all approach to these business sales, and really a lot of times, more often than not, there are multiple you know, sources of financing that are involved in the sale. You know, a lot of times it is, you know, you have to have some of your own money in it. A lot of times the seller will carry some of that debt back, and then you're looking at bank financing, or other potential sources could be maybe silent investors, or somebody that's maybe a relative that is willing to put some money into the business. But it really is a multi kind of faceted structure, if you will,
Sure.
a lot of times. Yeah. So
Several pieces to put it together type of thing.
absolutely.
Okay. Anything else you feel like we should cover, or thoughts that you'd want? One last maybe parting thing too. So the business is getting ready to sell, and they're getting ready to sell to a key employee. You know, is it often I've heard that it's great to go to the bank that the current owner is with. They understand the business well. They maybe understand the current ownership well. They've hopefully banked them for a while. You know, is that something that you see, or is it not really matter too much?
I think it's a logical path because
Okay.
you've had a relationship built there, but it doesn't have to be that way.
Okay.
I mean, I think it's a whole different ball game, but it does have its advantages, I would say, because you've already been tracking the business and you're getting regular statements, tax returns, all those kind of things along the way.
Okay.
Yeah.
Well, I want to thank everybody for tuning in and sticking with us here a little over time. I know we went over a little bit. I hope you gathered a nugget or two. I know I did, in terms of kind of, you know, in my mind, not quite as much as required as maybe I would have originally thought, you know, when I'm thinking about 5% versus maybe 10 or 20% when you're going to buy a home or something like that. If that's where you're comparing it to, and oftentimes we are, that's a more common thing to think about as a home purchase. But anyway, I appreciate everybody staying on with us today. Like I said, our next webinar will be May 23rd. We'll be working with the ownership of Agri-Plastics and talking with them about how they went from first generation to second generation within their company, and kind of some of the strikes and gutters along the way that they experienced and how they dealt with those things. So thank you, and have a great rest of your day.
All right. Thanks.
Thank you.